Okay, thank you. So this talk is about an gentle introduction to student loans. Because we wanted to preserve as much time as possible for Q&A, we split it into two parts. This first part is about borrowing student loans. The next webinar will be about repaying student loans. So if you're wondering why I'm not covering repaying, it's because it's going to be in a subsequent webinar. So let's start with just the basics, saying what is a student loan. A student loan is money that's borrowed to pay for college. It is borrowed money, so it must be repaid, usually with interest. There are some loan forgiveness programs that cancel the repayment obligation, but most student loans have to be repaid in full. And they break down into two main types: federal student loans and private student loans. Federal loans are funded by the federal government, the U.S. Department of Education, and private student loans are funded by other entities such as banks, credit unions, state loan agencies, and other non-bank financial institutions. And within the definition of student loans, we often use the word student loan generically to refer to all education loans. I'm told that I'm not sharing my screen. So let's see. And it's not letting me do that. It's using my webcam. Here, share screen. That's just settings. I apologize for this. There. And okay, so that should be visible. The talk should be visible now. Okay, so we're talking about what is a student loan. Student loan is a generic term that usually refers to all education loans, not just loans to students. So people sometimes ask, is a parent loan a student loan? And the answer generally is yes. And for example, the Federal Parent Plus loan is a loan that is borrowed by parents to pay for the education of an undergraduate student. Whereas all other loans are borrowed by an undergraduate or graduate student. Private student loans may require a credit-worthy cosigner, who most often is going to be the parent, but sometimes it could be a different relative or even a friend. Student loans have limits on how much you can borrow, both annual limits and aggregate limits. So an aggregate limit is the total amount you can borrow over the life of the loan. There are no prepayment penalties on federal and private student loans as a matter of law, so you can make extra payments on the loans and there will not be any fees charged for your doing that. So if you want to pay off your loan quicker, you can do so, and there are good reasons why you might want to do that. Typically, repayment of a student loan will be deferred while you're enrolled in school on at least a half-time basis and for 6 months after graduation. Some loans are longer, like the Federal Perkins loan is up to 9 months after graduation, but generally while you're in school and during a grace period after you graduate or drop below half-time enrollment, you don't have to repay the loan, though you can if you want to. Some lenders of private loans will even give you a discount if you make full or partial payments on your loans while you're still in school. So we talked about how student loans charge interest. How does that interest get calculated? What is the formulas? What does it really mean? So interest is a fee that's charged based on how much you owe, and it's usually expressed as an annual percentage rate, often as an APR, and that's a percentage per year though it's charged more frequently. I mean, it may be charged as frequently as daily or monthly based on a proportional amount of that interest. So there's two concepts. There's simple interest and compound interest. Student loans are simple interest, which is you take the balance of the loan, you multiply it by the proportional and that share of that annual interest rate. So if it's monthly, it's 1/12. If it's daily, it's 1/365. And that is the interest that is charged during that time period. Whereas compound interest, the difference between it and simple interest is compound interest charges interest on interest. So the interest, until it's paid, you get charged interest on that interest in addition to interest on the principal. It can be a little confusing, but compound interest is more expensive than simple interest. And it's worth noting, because this is often a point that students get confused about, I mean, if you default on your student loan, you're still going to be charged interest. If you are delinquent, you're still going to be charged interest during that delinquency period. Just because you aren't paying the loan doesn't mean you aren't charged interest. And similarly, during a deferment or forbearance period, which are authorized periods during which you don't have to make payments on the loans, you'll usually be charged interest. So I mentioned in compound interest and that the interest that if it's unpaid gets added to the loan balance. This is called interest capitalization. So if you have, let's say you're in a forbearance where you're not required to make payments, but interest is still being charged, it's called accruing. That accrued but unpaid interest will be added to the loan balance at the end of that forbearance period, and that increases the amount of debt. And because it's added to the loan balance, as soon as it's added to the loan balance, interest starts being charged on that interest. So that compounds the cost of the loan. It increases the cost of the loan. Generally, with federal student loans, interest is capitalized at loan status changes, such as when a loan enters repayment or at the end of a deferment or forbearance period. With private student loans, interest could be compounded, capitalized more frequently, even as frequently as daily. In the old federal guaranteed student loan program, individual lenders who participate in that loan program, which is also known as the Federal Family Education Loan Program, or FELP, could do it as frequently as monthly. Most of them mimicked what the direct loan program does, which is at the end of the deferment and forbearance period. And obviously, until that interest gets capitalized, added to the loan balance, there's no interest being charged on interest. And some of the repayment plans have special provisions that prevent interest capitalization, at least for part of the repayment term. And I give here the equation, not jump too much into the math, but if you have an initial balance, B, of the loan, and you're going to be defer in forbearance for M months, then the new balance will be the old balance plus the interest that accumulates during that M months, which is M times the interest rate per month times the balance. So in giving the both formulas for simple interest and compound interest here, and I'm just going to take very little time on this slide, you can see that simple interest, you're just calculating that interest by multiplying the proportional interest rate times the number of days, so the daily periodic rate times the number of days times the loan balance. Whereas with compound interest, you have exponentiation, so the interest is being charged on the interest and so on. Now, the current interest rates on federal and private student loans are shown on this slide. The interest rates on federal loans are fixed interest rates. They do not change for the life of the loan, but each July 1st, there is a new fixed rate for new loans that are dispersed from July 1 to June 30th. So the current rate's 4.529% for a undergraduate Stafford loan. are for loans that are dispersed until June 30th of 2020, and then there will be a new interest rate set. It's set based on the last 10-year Treasury note auction in May, and that will then apply to the 2020-21 academic year, whereas these are just for the 2019-20 academic year. The private student loan interest rates that I listed, and giving a sample of a few lenders, they are for new borrowers, not refinance, and they are as of May 1st of this year. And they include the effects of any auto pay discounts where the lender is discounting the rate if you sign up to automatically have your monthly payments transferred from your bank to the lender. The federal loans also have auto pay discounts of 0.25%, but they are not reflected in the interest rates that I show. And you'll notice I also include loan fees for the federal loans, which are about 1% and 4%, depending on the type of the loan. Private student loans, for the most part, add the fees, and they bundle it into the interest rate, so they charge a slightly higher interest rate. And you'll notice that unlike the federal loans, which are only available in fixed rates, many of these lenders offer both variable and fixed rates. Typically, the variable rate is going to be lower than the fixed rate, and that's in part because the variable rate has nowhere to go but up, and so over the life of the loan will be much greater. And you can see that these interest rates are fairly similar among the lenders. Like Discover has a lowest fixed rate of 4.74%, which is the same as what Sallie Mae offers. College Avenue is a little bit lower, but not all that much lower. There's more variation in the highest rates, and that's partly due to the lenders having different criteria concerning who's eligible for the loans. Like they may have a higher FICO score a credit score cutoff on eligibility, which affects the interest rates. Also, some lenders may have a lower best rate as an advertising gimmick. They might give that to only a few % of their borrowers, but that lets them advertise rates as low as the amount. So it can be hard to identify by the published information which lender is going to be best for you. You need to apply for the loan to see what interest rates they offer you. You can apply to multiple lenders, loan programs. You don't have to accept all of them, and the credit bureaus properly interpret shopping around behavior. So we mentioned that the federal loans have fees. It's basically an upfront form of interest. The purpose might be to cover the cost of originating, dispersing a new loan, might include advertising costs rolled into it, and guarantee fees, which guarantee the loan against default, and they cover the cost of defaults. And as I said, most of the private loans don't have any separate loan fees, or they have 0% fees. They bundle the cost of the fees into the interest rates. And if you're familiar with the mortgages, it's like the points on a mortgage. Though it doesn't really buy down the interest rate, it's just a separate fee. And in general, you can, for most of these loans, increase the amount you borrow to cover the fees. And when you're trying to think, okay, I have two loans, and I'll give an example later, one with higher fees and a lower interest rate and one with higher interest rate and lower fees, how do I tell which is cheaper? Generally speaking, on a 10-year repayment term, 1% in loan fees is the equivalent of a 0.25% increase in the interest rate. So 4% is equivalent of 1% increase in the interest rate. But that's only for a 10-year term. If you have a longer term, the rule of thumb is different. And there are also other types of loan fees like late payment fees, collection charges if you happen to be late or default on your loan. Now, we mentioned that there are limits, both annual and cumulative limits, on how much you can borrow. For the federal loans, they range for a dependent student from $5,500 as a freshman to $7,500 as a senior. If you're an independent student, it ranges from $9,500 to $12,500. If a student's parents are denied a federal Parent Plus loan, a dependent student becomes eligible for the independent student limits. And it's worth noting that the sum of the 4 years of limits for a dependent student is $27,000, which is less than the aggregate limit. So the only way you reach that aggregate limit is by borrowing for more than 4 years. And for graduate students, they have higher annual and aggregate limits. The aggregate limit for a graduate student actually includes the undergraduate borrowing, but medical school are much greater, but graduate students can also borrow the Grad Plus loan, which is similar to the Parent Plus loan. There is no real annual limit other than the cost of attendance minus other aid you've received. So you can't borrow more than the college costs, and there is no aggregate limit. So if you're there for 10 years, you can have 10 years worth of loans and just keep on going and going and going. Not advisable, but you can do it. The federal student loan limits were last increased in 2008. They are overdue for an increase. Many students in bachelor degree programs are starting to bump up against that $27,000 or $31,000 limit and needing to borrow more, which forces them to borrow from the parent loans or private loans. So now that we can see how much you can borrow, how much should you borrow? How much can you afford to repay? So we'll call this reasonable and affordable debt. Generally speaking, I define student loan debt as reasonable and affordable if you can afford to repay it in 10 years or less. So we start having to consider what's the relationship between the amount of debt and the amount of income that you have to repay that debt. And generally, if your student loan debt at graduation is less than your annual starting salary, you can afford to repay it in 10 years or less. Now, don't treat that as a target. It's better to borrow less because then you'll be able to afford to pay it back quicker and won't struggle as much to make the payment. But you want to have your total debt less than your annual income. If your total debt exceeds your annual income, you're going to struggle to make those monthly loan payments. And you'll probably end up needing one of the alternate repayment plans like extended repayment or income-driven repayment, which reduce your monthly payment by stretching out the term of the loan. And the problem with stretching out the term of the loan is that you're going to pay more in total interest over the life of the loan than if you had stuck with a 10-year repayment term. And if you stretch out the term of your loan to 20, 25, or even 30 years, that means you're still going to be paying back your own student loans when your children enroll in college, which means you'll be less willing to borrow for their education. You'll be less likely to have saved for their education. It's not a good situation. As far as figuring out in advance what your salary might be, if you know what your academic major is going to be, what kind of occupation you're pursuing, there are a lot of sources out there for income information. There's payscale.com, salary.com. There's an organization called NACE, the National Association of Colleges and Employers, and they publish annual starting salary data by major. And there's also the Bureau of Labor Statistics, BLS.gov. So all of these are sources of income information. And if you multiply that by 4 and you graduate in 4 years, that'll probably be within about 15% of your actual debt. And take your first year debt and multiply it, recognizing that the loan limits do increase through each year in school. But in general, you don't want to treat these loan limits as targets. Borrow as little as you need, not as much as you can. And my analysis has suggested that about 1 in 6 students who graduate with excessive debt, which is debt that exceeds their annual income. But most of them, and while this may cause them to delay major life cycle events like buying a car, getting married, buying a house, having children, saving for your children's college education, and saving for retirement, it doesn't cause them to default. And most of the defaults come from students who don't graduate. They have the debt, but not the degree that can help them repay the debt. And clearly, you want to keep your student loan debt at graduation in sync with your income after graduation. If you find yourself needing to borrow private or parent loans, it may be a sign that you're borrowing too much money. So this chart shows that the amount of debt at graduation, the average amount of debt, correlates very strongly with the cost of the college. Compare the cost of attendance with the average private student loan debt at graduation. You can see it increases as the cost increases. So if you go to a more expensive college, you are more likely to graduate with debt and with more debt than if you go to a less expensive college. So an in-state public college is often one of your cheapest options. You're less likely to have to borrow private loans, and you're more likely to graduate with less debt. And this is a similar chart. This is comparing it to the net price, which is the difference between college costs and gift aid, the grants and scholarships and other money that you don't have to repay. The net price is the amount of money you're going to have to pay from savings, current income, and loans. So again, at a higher net price college, you are more likely to borrow, and you'll borrow more money. Now, there's an interesting relationship between federal loans and private loans. Federal loans are better loans. They're cheaper, they're more available, and they have better repayment terms than private student loans in general. I mean, comparing the Parent Plus loan to private loans, if you have really good credit, sometimes you can get a lower interest rate on the private loans than on the Parent Plus loans. But other than that, in general, the student loans, I mean, especially undergraduate student loans from the federal government, are going to be much less expensive on a fixed rate. I mean, don't compare a fixed rate with a variable rate because that's not an apples-to-apples comparison. But as you can see, private student loan volume was growing very steadily. It peaked at about a quarter of total outstanding student loan volume that was added each year. And then it plummeted in the years after 2006-07 when it peaked. The reason for this is that's the year the federal government created the Grad Plus loan, so a lot of that graduate student borrowing shifted to the Grad Plus loan. And also in 2008, the loan limits caused a decline in private student loan volume. And since 2010-11, the private student loan volume has been creeping up. It bottomed out at 7% of annual borrowing, and now it's at 11%. And the reason for this is that the federal loan limits haven't increased, and undergraduate students in bachelor degree programs are increasingly hitting the federal loan limits. And so they have, if they want to borrow to pay for college, they have no choice but to often to borrow private loans. And the parent loans are available, but most of and we've definitely seen an increase in parent borrowing, but it's also causing an increase in private student loan borrowing. So there are 5 main types of federal education loans. There are the subsidized Stafford loans, which are available only to undergraduate students. They used to be available to undergraduate and graduate students, but in 2012, Congress decided to limit them to undergraduate students. There are unsubsidized Stafford loans, which are available to both undergraduate and graduate students. There are Grad Plus loans and Parent Plus loans, which are both versions of the Plus loan. And there are consolidation loans, which you use after you graduate to merge multiple loans into a single loan if you desire to do that. The interest on the subsidized loans is paid by the federal government during the in-school and grace periods. And on the proportional part of a consolidation loan that came from subsidized loans, that's paid by the federal government during those 2 time periods. So if you graduate, consolidate your loans, and then go back to school, the federal government will pay the interest while you're in graduate school. But in the unsubsidized loans and the unsubsidized portion of a consolidation loan, that's your responsibility as the borrower, and you'll have to either pay that as it accrues, or you'll have to have that interest capitalized. It's one or the other. So now we start thinking, which of these are better? And I already gave you a hint that federal loans are better. The interest rates on federal loans are fixed, and they are generally lower than the interest rates on private loans. They're also more available. You don't have to have excellent credit to receive a federal loan, whereas private student loans are generally credit underwritten, meaning that your credit scores and the credit scores of your cosigner, if any, will have an impact on the interest rates that you are required to pay. But then the private loans have some flexibilities, like you don't have to file the FAFSA to qualify for a private loan. They offer more payment options during the in-school period. With the federal loans, you can either start paying the loans while you're in school if you wish, or you can defer them until after you graduate, until the end of that grace period. Private loans offer interest-only payments, fixed $25 per loan per month, as well as immediate and full deferment. And some lenders will even give you a interest rate reduction if you agree to make those payments during the in-school period. They call them touch payments, which keeps you as a borrower in contact with the lender and makes it less likely that you're going to forget that you have these loans. You're less likely to be late or to default if you sign up for in-school payment, usually with an auto pay option where the monthly payments are automatically transferred from your bank account to the lender. Private student loans are limited to 1 year total in deferments, usually in increments of 2 to 3 months, whereas federal loans have up to 3 years, and they offer both deferments and forbearances, whereas private loans only offer forbearances, though they may use those two terms, deferment and forbearance, interchangeably. The repayment term for federal loans can be anywhere from 10 to 30 years, whereas for private loans, they tend to have shorter repayment terms, and your interest rate may be lower the shorter your repayment term is. Income-driven repayment, where your monthly payments are based on your income as opposed to the amount you owe, are available for federal loans but not private loans. There's one loan in Rhode Island for Rhode Island residents that has a version of income-based repayment, but that's the only exception to the rule. Federal loans offer many more debt and discharge options like death, disability, closed school discharges. Some private loans have a death discharge. Some also have a disability discharge, but some don't. And there are loan forgiveness options for teaching or public service on the federal loans, but not on the private loans. So if I were to list them in rank order from cheapest to most expensive, the Stafford loan, especially the undergraduate Stafford loan, is the least expensive, followed by the PLUS loan, and sometimes you might get a home equity loan that may offer a fixed rate that's cheaper than the PLUS loan, but then you're risking your home. If you default on a home mortgage, they can foreclose on your home. Whereas if you default on a federal student loan, they can't repossess your education. Private loans, if you have excellent credit, you might get an interest rate that's lower than the Parent Plus loan. You will not get a fixed rate that is lower than the Stafford loan. And then most expensive is credit card and other forms of non-education debt. So how do you apply for a federal student loan? First, you FAFSA. You file the free application for federal student aid. That's a prerequisite. Then the financial aid office will determine whether or not you're eligible for the loans and which types of loans and how much you can borrow. So usually this is the subsidized Stafford. They'll base that on your financial need up to the limit of your financial need. And then the rest will be borrowed as an unsubsidized Stafford loan. With the other loans, it's more straightforward. And a lot depends on each college's policies. Then the college will tell you how much you're eligible for through a financial aid award letter or financial aid notification. You don't have to borrow the amount that they list on that award letter. Sometimes the amount on the award letter will be less than the maximum, but usually it'll be the maximum for which you're eligible. But you don't have to borrow to the limit. And sometimes they will do what's called packaging plus, where they will include the Federal Parent Plus loan on that award letter. And you need to be very clear when you're looking at that financial aid award letter, what's a loan and what's a grant. Because sometimes they'll just say Fed Staff or Fed Staff L and assume that you know that that means it's a loan and which loan it is, or Fed Plus or Plus. And so it can be really confusing to figure out what is a grant, what is a loan, and therefore what's your net price versus, and loans have to be repaid, so it's not cutting your college costs. And then after you tell the school how much you're going to borrow, the school will require you to sign a master promissory note, which is like a regular promissory note where you promise to repay the debt, but it can cover a period of continuous enrollment up to 10 years. So you won't have to sign the master promissory note in subsequent years, so long as you don't drop out or leave or transfer to another college. And you will also be required to undergo what's called entrance counseling, which is a form of loan counseling that reviews the terms of the loans. Exit counseling, when you graduate, is a little bit more important. It not only discusses your rights and responsibilities, but also your options for repaying the debt, such as the various repayment plans. Now, on some schools that have a high default rate, there may be an automatic 30-day delay before the loans are dispersed, and they may require 2 disbursements, one in the fall and one in the spring. The disbursements, when they occur, will be first applied to the college's charges for tuition and fees, and if you live in college dormitories or other college-controlled housing, for room and board. Any remaining credit balance after these charges will be refunded to you within 14 days. So you have 30 days plus that 14 days if you're a first-year student who hasn't borrowed previously. For private student loans, you apply directly with the lender. You don't go through the government. The government has nothing to do with those loans. You don't have to file the FAFSA if all you're borrowing is private loans. So the federal loans are cheaper, so you'll want to file the FAFSA if you're eligible for the federal loans to get those cheaper loans. Typically, there's an online application on the lender's website, and that's when they pull your actual credit score, and that usually they will give you denials within minutes, and there may be a wait of a few days to get an approval. Some will do real-time approvals. A lot depends on the details of your credit history. If you have any serious delinquencies in your credit history or other derogatory events like bankruptcy, discharge, foreclosure, repossession, tax liens, and wage garnishment, they're going to take a few days to review it before either approving or denying it. And these days, the lenders, if there's anything potentially wrong with your credit history, they're probably going to deny it. And these days, most private student loans are what are called school certified, where they contact the school to confirm your enrollment and what your remaining loan eligibility is. In other words, after all financial aid has been applied to the cost of attendance, what's the remainder? That's the limit that you can borrow through that private loan. Some private loans also have annual and aggregate limits, but usually the dominant factor is going to be the cost of attendance minus any other aid. There used to be direct-to-consumer loans. Most loans are school certified these days. A direct-to-consumer loan, the college was not aware of them. The payment was made to the family, the borrower, not to the school. And these were prone to abuse and fraud, and that's why they've generally ended. They're also not eligible for the student loan interest deduction, whereas school-certified loans are. One thing that you should do before applying for a private student loan, because they are based on your credit scores, and is check your credit history. You can do that for free at annualcreditreport.com, which is a website that was set up by the Federal Trade Commission, and that all 3 major credit reporting agencies, Equifax, Experian, and TransUnion, will let you have a free copy of your credit report through that website. And what you want to do is make sure there aren't any errors, because an error, like if they say that you were late with a payment when you weren't, or that you defaulted on loan when you didn't, and that can have a major impact on whether or not you get approved for the private loan. So check your credit report, correct any errors, and then apply. If you want to improve your credit scores, which you can't currently get through the annualcreditreport.com website, the 3 credit reporting agencies usually charge you money for the credit scores, but you can get it free, and there are some, like I think Discover, the credit card, provides your quarterly credit scores for free. There are other tools that you can use to get free credit scores. If you want to improve your credit score, because that has an impact on the interest rates that you get, make on-time payments for every debt, regardless, not just student loans, credit cards, store credit, and any form of credit. You want to be paying down and paying off the balance on your credit cards, making progress in paying down that debt, being on time, even if there's a grace period, get your payment in before. Now with private student loans, 90% for private student loans to undergraduate students require a credit-worthy cosigner. The higher of your credit score and their credit score is what's going to dominate the interest rates that you get. So it is to your advantage to have a credit-worthy cosigner co-signing your loan, though there are reasons why the cosigner might not want to do it because it ties their credit to yours. Okay. Now, if you want to cut your cost of borrowing student loans, the first thing is to focus on free money first, because that's money you don't have to repay. So take advantage of any grants and scholarships, file the FAFSA so that you get all the grants for which you're entitled, apply for scholarships. That will help you reduce the amount that you need to borrow. Obviously, save for college before college, because every dollar you save is a dollar less you're going to have to borrow. And college savings is the antidote to student loan debt. Before you consider borrowing, think about maybe using a tuition installment plan. Sometimes they're called tuition payment plans. They usually are made available through the bursar's office. They are a short-term financing, less than a year in total duration. And they are there if you can afford to pay the bills, you just can't pay it in one big lump sum. It breaks it up into monthly installments over the course of a year. There is no interest being charged, but there may be an upfront fee that's typically less than $100. Also, just because you have all this money, and many students are not used to having that much of a refund, even though that refund is to buy textbooks and pay for other costs. And so they'll live large and run out of money. I mean, about half of all freshmen will phone home sometime during their freshman year asking the parents to send more money because they spent it all. So you need to live like a student while you're in school so you don't have to live like a student after you graduate. If you borrow too much, I mean, every dollar you borrow is going to cost about $2 by the time you repay that debt. So you ask yourself if you would really spend that money on whatever you're trying to buy if you had to pay twice as much. And as I said before, federal loans are cheaper, and they have better repayment terms than private student loans. And if you want to reduce the interest rate on your private student loan, having a credit-worthy cosigner, even if they don't have a better credit score than you, will still help you reduce your interest rate because from the lender's perspective, they have two fish on the hook instead of just one. Another way to save is to work a part-time job while you're in school. You can earn up to about $6,800 before it affects your financial aid. But don't work a full-time job, because students who work a full-time job are half as likely to graduate as compared with students who work 12 hours or less a week. It is literally cheaper to save than to borrow. The difference is that when you save, you're earning the interest. When you borrow, you're paying the interest. So if you were to save $200 a month for 10 years and compare that with the cost of borrowing the same amount of money with a 10-year repayment term, the monthly payments on that debt are going to be about twice the amount that you save before college in a college savings plan. So you're better off saving. And if you vary the details, it'll vary a little bit, but it's always about a factor or two difference. Now, as I alluded to earlier, student loans can be really, really confusing. And trying to figure out which loan is going to be your best deal. I mean, if you've got a loan that has a 4% fee and a 9% interest rate versus a loan with a 5% fee and an 8% interest rate, how do you tell which is going to be the better loan, the cheaper loan? So recall I discussed a rule of thumb earlier that 4% in fees is equivalent to 1% in interest rate on a 10-year term, or in simplified, 1% in the interest rate is much more expensive than 1% in the fees. And be very careful about looking at the APR of a loan when the loan has a different repayment term than the other loan, because when you increase the repayment term, the APR actually goes down even though the loan is more expensive. It's not really a great tool for comparing loans that have different terms. If they have the same term, it's a good tool. Different terms, not. So it's best to use a student loan calculator to compare the two loans and focus on two aspects of the analysis. One is, what is the difference in your monthly payment? And the other is, what is the difference in the total payments over the life of the loan? A loan with a longer repayment term will have a lower monthly payment, but will cost you more over the life of the loan. So you have a lower payment at the expense of paying more because you're paying it for longer. And we just released several student loan calculators on the Saving for College website, and we'll be releasing more over the next few weeks. Here's an example of our loan payment calculator. I just threw in some arbitrary numbers: 30,000 debt, which is about the average debt at graduation for a bachelor's degree, a 5% interest rate, 10-year repayment term, and it shows you that the monthly payment is $318 a month. And you may notice that $318 is like 1% of the amount you borrowed. And in fact, that's a good rule of thumb that if you want to know how much you're going to have to pay on a 10-year repayment term, chop off the two least significant digits, and it'll be in the right ballpark. And then some advice for borrowers. Interest capitalization is going to increase the cost of your loan, so you want to try to minimize it. If you can, while you're in school, make payments on the loans of at least the interest so that the loan balance doesn't grow, because typically if you defer repayment until you graduate, the size of the debt at graduation is going to be anywhere from 20 to 30% bigger than the amount that you receive to pay for school, depending on the length of the in-school period and the grace period before you start repaying the loan. So you can avoid that by making payments while you're in school, and there are several lenders that offer you discounts for making in-school payments. So not only are you avoiding interest capitalization, but you're actually reducing your interest rate, saving additional money. For similar reasons, avoid a leave of absence because that can lead to interest capitalization. Don't borrow more than your expected starting salary for your occupation. Borrow as little as you need, not as much as you can. While you're in school, open and read your mail that you get from the lender or from the financial aid office, because this may contain a form that you need to file. If you don't open it, you may go into default on your loan because they may be asking you, are you still enrolled in school sometimes? Try to be organized, because all too often students graduate, they have a 6-month grace period before repayment begins, and they forget about their loans. And so it's a lot easier to just keep track of all your loans as you receive them, keep the documents in a file folder, and have a summary sheet that says what the lender name is, their website, the interest rate, the amount you borrowed, the monthly payment will be, when payments begin. So you have all that information handy for when you graduate and need to start worrying about repaying your loans. And even though the exit and entrance interviews, which are online these days, can be a little bit boring, there are some nuggets of information that are worthwhile, and some colleges actually roll in some financial literacy training as well. Thank you. We'll now open it up to questions.
Awesome. Thanks a lot, Mark. So we got a lot of questions. Sorry for those that we do not get to, but we're going to be writing articles and releasing some new material on these questions in the coming weeks. So starting out, we have one that asked, are loans to parents also deferred while the student is in school?
So the Federal Parent Plus loan is deferred while the undergraduate student is enrolled at least half-time and for 6 months after graduation. Before 2008, it would go into repayment within 60 days. And if you want, you can do that. It's still an option. But most parents will defer while the student's in school until 6 months after graduation.
Awesome. Another one here, we have, what benchmark rate are these federal rates tied to? Is it the LIBOR, the prime rate, what?
It's tied to the 10-year Treasury note auction, the last one in May, which is coming up within a week. So within a week, I will know what the new interest rates will be on federal loans starting July 1st.
Great. We also have someone asking, is there a student loan broker, like a mortgage broker, who can help you shop for the lowest rate and best loan for you?
There are several websites that do these kinds of loan comparisons. And one's called Credible. There's another called Simple Tuition. We will have a shopping page on our website where you can compare the terms of the loans. And we are in the process of developing a 5-cap rating system for the student loans. Just like we have 5-cap ratings of the college savings plans, we're going to have a 5-cap rating for the student loans. It'll be 100% objective based on several dozen data points that affect what matters to the borrower. And we will assemble that, and it'll be automatic. We'll update the data probably monthly or quarterly, and that will give you a way of comparing the loans. And we'll even provide some tools that you can personalize the rankings based on your preferences and your situation, like what state you live in.
Great. And what do you anticipate the loan rates being with COVID-19 and the world that we live in right now? What do you anticipate them? How do you anticipate them changing?
Well, as I said, the federal student loan interest rates are based on the last 10-year Treasury note auction in May. There are monthly auctions, so based on the April auction, if that's reflective of what the May auction will be, I'm expecting the interest rates to go down by about 1.5% to 2%. We'll see what happens with all that unemployment, and the interest rates in may be different than the ones in April. And usually April is predictive of May, but this time around with coronavirus, things are a little bit crazier. So we'll see. The private student loans are typically based on the 1-month or the 3-month LIBOR index. And so some of them will have already reflected that change in the federal funds rate, which then influences the LIBOR index. But if it's a 3-month LIBOR index, that's an average of the last 3 months of LIBOR interest rates. It can take them 3 months to catch up. So some of the loans that are based on the 3-month LIBOR are still phasing in the impact of the interest rate reduction. So it should be cheaper for the federal loans. It may even be reaching a new record low for federal loans. The previous record low was back in 2005 when they were as low as 2.88%. We may see them closer to 2%, but then remains to be seen.
Got it. And then for somebody whose EFC is $0, is it advisable to begin at a community college and then transition to a 4-year college?
Right. So regardless of whether you have a 0 EFC or not, I recommend that if your intention is to obtain a bachelor's degree, you start off at a 4-year institution. A couple of reasons for that. Students who start off at a 2-year institution intending to obtain a bachelor's degree, only about 1/5 of them succeed in getting that bachelor's degree within 6 years, whereas students who start off at a 4-year institution, about 2/3 of them graduate within 6 years. So you taking a detour through a community college may save you a lot of money, but you may ultimately miss your destination. It's not a lot really known about why this is the case, and it may be that the financial issues that forced you to go to a community college persist. It may be that you're in an environment where most students are not intending to obtain a bachelor's degree, and that may rub off on you. But all I can say is what the statistics say. But I mean, generally, community colleges are great if your goal is to get a certificate or associate's degree. But if your intention is to obtain a bachelor's degree, you may be better off starting at a four-year school.
Got it. And what do you think is the possibility of loan forgiveness in general for medical students in particular?
So a lot of people have been saying that the frontline doctors and nurses should be rewarded in some manner, and some people have even said forgive all their student loans, but I mean, that obviously doesn't help the frontline workers who long ago paid off their student loans. I mean, it's hard to say what's going to happen. There have been proposals to forgive $10,000 of student loan debt or $30,000 of student loan debt. There was Senator Warren and Senator Sanders each had proposals for widespread loan forgiveness as part of their campaigns for election as president. Joe Biden has moved more in that direction and is proposing some loan forgiveness as well. A lot depends on who's elected president, and even if they're elected president, they still have to convince Congress. And it's worth noting that of the 25 candidates for president, only 4 of them were proposing widespread loan forgiveness. So that suggests that they not only would have to convince Republicans to pass loan forgiveness legislation, but also perhaps the Democrats. So I don't give it very good odds that they'll be successful, even if a Democratic candidate is elected president.
Okay, and then what is the true likelihood of teachers in particular getting forgiveness options?
Right, so there are already 2 loan forgiveness options for teachers. There's teacher loan forgiveness, and there's public service loan forgiveness. And there's also the Teach Grant, which is a $4,000 a year, slightly lower than that because of sequestration, but it's about $4,000 per year. That's really a forgivable loan, not really a grant. But people have heard that borrowers have had trouble getting the Teach Grant, the teacher loan forgiveness and public service loan forgiveness, which a teacher loan forgiveness, the servicer was very nitpicky. If you were a little bit late with filing the annual paperwork, you would lose the forgiveness. Well, since then, there were lots of complaints. The U.S. Department of Education has created a process that if you're still fulfilling the teaching requirements and you just happen to miss the paperwork deadline by a few days, they're going to reconsider you for the loan forgiveness. Because if you're doing what the intention of the law was, then you should be able to get it. With public service loan forgiveness, you may have heard that only 1% or 2% of borrowers who applied have qualified for the loan forgiveness. And that's partly because some of the borrowers have been wishful in hoping that their loans would be forgiven when they didn't actually qualify. For example, a significant number of the people who applied for the loan forgiveness hadn't been in repayment for 10 years. Well, to make 120 qualifying payments, you have to have been in repayment for at least 10 years. But on the other hand, the loan servicer, there have been several documented cases and several borrowers that I've helped where the servicer didn't count the number of qualifying payments correctly. So it seems that both the borrowers and the loan servicer have trouble counting qualified payments. I expect more students over time to qualify for public service loan forgiveness. They were just jumping the gun a little bit, and that if they continue making their required payments, qualifying payments, they will eventually qualify for the loan forgiveness. And also the loan servicer will get better at time at counting the number of qualifying payments.
Okay, and can a non-custodial parent get a Parent Plus loan when they weren't the one to complete the FAFSA?
Yes, but the total amount borrowed by the non-custodial parent and the custodial parent and the student can't exceed the cost of attendance minus other aid. So each can't borrow the full amount, and you have to borrow less, or one borrows and the other doesn't.
Okay. And then for federal student loans, do they ask for a parent's savings account and for the student's savings account information, like how much they hold?
Right. So for federal loans, you're going to fill out the FAFSA. The FAFSA asks for income and asset information for the student, and if that student's a dependent student, from the student's parents, if that student's an independent student and is married, from the student's spouse. So yes, your bank account information and the amount of assets you have, not your account number, just the assets, will need to be reported as an asset on the FAFSA. When you apply for the federal student loan, it's not credit underwritten for the students. The Parent Plus loan does have a very modest check of your credit history. It doesn't depend on your credit scores or your debt-to-income ratios. It's simply looking, do you have any debts that are in a serious delinquency, which is 90 or more days, or within the last 5 years, have you been in default or had a repossession or foreclosure, tax lien, or wage garnishment on any debt within the last 5 years? If you have, there is an appeals process, but and that's what the purpose is. So it's a very mild credit check.
Got it. And if you don't borrow the full amount of federal Stafford loans that you're eligible for, will that reduce the amount, or can that increase the loan amount you're offered in subsequent years? Basically, can you save up that qualifying amount?
Right. So for student loans, federal student loans have annual limits and aggregate limits. If you don't borrow your freshman year, you can't, during your sophomore year, borrow your freshman year limits in addition to your sophomore year limits. It doesn't work that way. There is an aggregate limit, and if you didn't borrow as a freshman, you do have more left over in that aggregate limit. So if you didn't borrow as a freshman, but you took 5 years to graduate, you might be able to borrow more during the second through fifth years.
Got it. And then somebody asked, I thought that all first-time students had a 30-day disbursement delay. Did that change?
No, and at schools that have very low default rates, they have a waiver of the 30-day delay and the multiple disbursement rule. If a college has a higher default rate, it's called the cohort default rate, then they have to comply with the 30-day delay and the 2 or more disbursements.
Okay. And can a student have 2 co-signers for a loan?
Theoretically, yes. Very rare for that to occur. And generally that occurs when the student applies for a loan, has a co-signer co-sign the loan, and isn't approved. And then when they're negotiating with the lender says, well, do you have another co-signer who's got better credit? And if you do, then that additional co-signer co-signs the loan.
Okay. And for those repaying student loans, do they get a tax credit or tax deduction for the payments of student loan interest? And does it matter if it's a federal or private loan?
Okay, there is a student loan interest deduction, which is implemented as an above-the-line exclusion from income. So it's not counted as it's subtracted from your income for up to $2,500 in interest paid on federal and private student loans. The technical term is a qualified education loan. All federal loans are qualified education loans. Most private student loans are qualified education loans, but some are not. And it has to be used solely to pay for qualified higher education expenses. And there are other criteria that may cause certain loans to not be considered qualified education loans. An example of a loan that is not eligible is a bar study loan, because that loan is made after you graduate, and therefore it is not a qualified education loan.
Okay. And then we have one last question here. Does the grace period for federal loans extend if you go into medical school or any sort of graduate school?
Right. So there's a 6-month grace period after you graduate before you have to enter repayment on your loans. If you then go into additional education, there is a in-school deferment that applies that causes your loan to not have to be repaid while you're in grad school or medical school. Or maybe you go to a different school to get a different degree and you You decided to switch fields from being an engineer to being a nurse, and you decide to go back to school. Well, during that subsequent education, your federal student loans will be deferred.
Awesome. So that's all the time we have for questions. Still have like 50 more on the queue, but like we said, Mark's going to be answering those in subsequent articles, and check out savingforcollege.com for more information. Mark, do you have any final thoughts for everybody?
I will write several probably articles that are answers to questions about borrowing student loans or something like that. And we will try to get to most of these questions that I didn't have time to answer during this webinar.
Great. Thanks so much, Mark, and thank you everybody for joining.